Welcome, everybody. My name is Jimmy Lee. I'm the CEO of the Wealth Consulting Group, and I'm joined today by our Chief Investment Officer, Jim Worden, and also LPL Financial's Chief Market Strategist, Ryan Detrick. And we've got a full agenda. I think the presentation is going to go probably around 30 minutes or so. Unfortunately, for compliance reasons, we can't have anybody ask questions, but for the clients that are on this call, please, when we're done, if there are any questions that you have based on what we're discussing, please reach out to the financial advisor, wealth advisor that you work with, and they'll be sure to get back to you right away. But we have a good agenda to talk about today. I've got my notes here to kind of help me out with that. I want to thank all the clients first, though, that are on this call. We really do appreciate your business. All of us at the Wealth Consulting Group, all the advisors understand how important the relationship is with client and advisor. And we really appreciate you participating on this. For those of you that will listen to this on a recording, again, please feel free to reach out as soon as you would like. If you have any questions to your advisor, and then if there are any questions for us, you can also have your advisor forward that to us or reach out to us directly. We might be able to ask Ryan to answer questions. If you have any questions for Ryan, you can forward that to me or to Jim or your advisor. One thing that I wanted to discuss before we get to Ryan's deck, and what we did in a pre-call today was kind of talk about how we can make this the most beneficial to the people that are listening and watching the call. And we decided that trying to keep this as conversational as possible between the three of us would make the most sense. And so we're going to go back and forth maybe from some slides that we have, but we're going to address a lot of different issues. But before we get to the slideshow that Ryan's prepared for us, I wanted to talk with Jim just a little bit about what we've done in our investment committee with changes that we've made, which we're very proud of and happy for, in terms of the results so far with the volatility that we've had in the marketplace this year so far. And for the people that don't know this, I wanted to make sure that everybody listening, understands the process that we go through at the Wealth Consulting Group within our investment committee and how decisions are made and how they're implemented, in the portfolios that we manage for our clients. So our investment committee meets regularly, every single week on Tuesday morning, 8 a.m. Pacific, like clockwork. We've done this now for years. And as people have come in and out of our committee, the faces are very familiar for the most part, meaning that we have a lot of experience working together within our firm on our investment committee. On those weekly calls, we discuss what's going on, that's very tactical maybe for that week or for that day. Oftentimes when there's a lot of market volatility, we'll have, I wouldn't call them emergency calls, but ad hoc calls in between those weekly calls. And we discuss different things that we think are important that we need to potentially make decisions on with changes that we may want to make based on what's going on. But for the most part, we're being very proactive and not being reactive in how we're making decisions about the portfolios and the models that we manage. On a monthly basis, we have our investment committee call with all of the advisors within our firm. We discuss performance of the portfolios against different benchmarks. So we're reviewing the performance very frequently. And then every single quarter, we also have our portfolios reviewed by one of our asset management partners. Some of the biggest names in the world in terms of money management have consultants on their teams that look at our portfolios and give us their recommendations on, maybe different sectors that they believe that we should be adding to or taking away from, and other different things that we might want to discuss with them. So a lot of eyes being looked at in terms of what we're doing. And then we take all of that input that we, get through those different types of discussions, as well as all the data that we purchase from data providers for research, Morningstar, Bloomberg, Your Stake now, lots of different sources where we get research, including LPL Financial, which we'll get to here in a minute. But we get a lot of research, and with all that information is how we make decisions within our investment committee, and working closely with your financial advisor and implementing those strategies within our client accounts within the group. And so, Jim, I wanted to ask you, I know that, months ago, we took some money off the table in the technology sector and added it to sectors like energy and commodities. And right now we're currently overweighted in energy. So on the equity side of our portfolios, we've had some really good relative performance year to date. I know that we've had some discussions this week with our investment committee and advisors about that, and making sure that they remind, all of our clients of what's going on. We never like to see, the portfolios down, but being down less at least feels a little bit better. We also made some changes in the allocations for the fixed income side of our portfolio for the bond side. And so maybe, Jim, if you can just spend just a couple of minutes on some of the decisions that we made and why we did that, and to give, a little bit of flavor of how the committee operates when it comes to asset allocation.
Sure. Thanks, Jimmy. And good to be with you, everyone. So yeah, as Jimmy mentioned, we do meet every week like clockwork. And we discuss all things technical, fundamental. We look at valuations. And so we've actually been talking about making changes for quite a while, actually prior to reducing our exposure to technology. During the pandemic, we actually did have an overweight to technology by about 5%. That actually helped our portfolios during the pandemic. Then that was reduced, and we've been reducing it really since October of last year. And we've been adding energy, financials, our exposures to materials and industrials, as well as consumer staples, has also increased. On the fixed income side, we've also been concerned about what the Fed would do, what they said they were going to do. And we've reduced our duration or interest rate sensitivity to some of those areas that were most sensitive to interest rates. And so making those changes, and by the way, all those changes did not all happen at once, but we continue to look at the data. We're very data dependent. So we made some changes in October. We made some more changes in January. We made some small changes in March to continue to make adjustments to the portfolios. And in several cases, we're doing about 5% better than our benchmark, 5% better than the S&P 500 in terms of relative performance. But all of those decisions came through meetings in the investment committee, a lot of deliberation and debate, analysis of valuations, looking at things like momentum and some of the research tools that we have.
Thanks, Jim.
Yeah.
And Ryan, I wanted to ask you to talk a little bit about your personal views and maybe even the house views with LPL. But before I get there, for those of you that are not as familiar with LPL Financial, LPL is the largest by far independent brokerage firm in the industry, with over 20,000 advisors affiliating with LPL. Custodying over $1 trillion in assets, 1.2 approximately before this recent downturn, I think. And so a major player, in the broker dealer space, the RIA space, and a back office partner, a strategic partner for us at the Wealth Consulting Group, where we custody the majority of our client assets. Ryan is quickly become one of my favorite people at LPL. You might see him on CNBC. He's on frequently on a lot of the best shows that I love to watch, like Squawk Box, and he's a technician. He's a CMT. Jim, also on our investment committee as our chief investment officer, is also a CFA, CMT, and CAIA. A CMT means that they're like technical market technicians, and Jim's CAIA means that he's got an accreditation for being knowledgeable about alternative investment strategies as well. So with that, I wanted to ask Ryan, before we get into some of these slides, just kind of his own views and maybe the house views on where he thinks we are in the market, and what to expect possibly in the short run for the remainder of this year and then going into the next.
Yeah, well, thank you, Jimmy, and thank you, Jim, and thanks everyone for being here today. So first off, you guys are really lucky, because some of the decisions that we just talked about, I know it kind of happened fast there, to be going into energy, getting out of tech, shortening your duration. the truth is this, we'll talk about it. This has been a really bad year for stocks. We know that. It's been a rough year for bonds. We know that. But again, on a relative basis, some of those decisions we just talked about are huge. And again, what the team's doing for you, you can't minimize that. So it's a great job, guys. I love hearing that. But I will share one slide. I know we said maybe get into it. Let's just do a big picture thing, right? I mean, coming into this year, was LPL Research bullish? Yes, we were. But we knew some things coming in. First off, guys, it's crazy to think, right? A couple years ago was the lows, March 23rd of 2020. Remember the pandemic lows, fastest bear market ever. That born a new bull market. So we're in the third year of a bull market. What I'm sharing here are some of the previous longest and best bull markets ever. Now, what you need to remember about this one, this was the fastest bull market to ever double, up 100%, okay? You can see it there. It doesn't look like a lot, but trust me, it was. It was the fastest one to double. We were really spoiled. So coming into this year, we were saying, listen, it's a midterm year, and we're going to talk about some of that. The economy's aging. The Fed's going to start hiking. Some of these things said, it could be a little rockier year. Did we expect this to be literally like one of the worst starts for stocks ever? No, we didn't say that. But, we did say, listen, a 10 to 15% correction at some point during this year after over 100% rally, it made sense. And just kind of eyeball that slide I'm sharing there, from the second birthday to the third birthday, to call that year three. Stocks sometimes just go sideways. Sometimes they pull back. Why is that? Well, because usually the first and second year of bull market is when those huge gains come in. Then the economy maybe slows. Maybe you got some other potential issues. We're going to get into all the issues. We know what the issues are, right? But just structurally, it kind of makes sense to have a little bit of a pause here. And that's clearly what we've seen this year with the almost, I think, 17 or 18% correction after today's action on the S&P 500. But, that's just the big picture stuff, Jimmy. We still think we're in a structural bull market. We do not see a recession. We can get into all this stuff, but I think it's just time for a little break. And that's simply where we are. And as investors, we need to remember, we are still, it's easy to say this, right? We're a lot higher than we were a few years ago, but it's the truth. These things don't go up forever. 2011, stocks are flat. 2015, stocks were flat. 2018, the S&P was down 5%. Yet during that 10-year bull market, stocks gained almost 400%. Right. So you just got to remember, sometimes you have these periods of indigestion. And trust me, this year feels like some major indigestion, actually. Year's not over. We're still pretty optimistic that these are going to be some pretty good buying opportunities, as again, we do not see a recession, which means likely this could be a good opportunity, honestly, for some decent gains the rest of this year, Jimmy.
Great. And we're going to get into that because there's a lot of debate about that big R word, recession. And
yes.
So we're going to hit a lot of different points, I hope, before we end this call or this meeting today. But we're going to talk about inflation, the Fed, the strength of the consumer, interest rates, of course. How normal, which is the title of this presentation, is 2022, because we're going to talk about midterm election years. Yep. And what typically happens. The idea of selling in May, maybe not always, earnings being, probably the most important thing outside from some of the things that we've discussed with Fed and inflation and all that, and also the war in Ukraine. And then I want to also touch on what's different, what looks the same, like we're going to be talking about how normal is 2022, but also what looks different. So a lot of different areas to cover. I know that you've got a slide for everything I just said, but in talking about recession, I would say, Ryan, that now you are in the contrarian camp, in terms of, I would say, analysts, people that talk a lot on TV like you and about where we're at. I've heard some very smart money managers, economists saying that recession is inevitable based on what the Fed's going to have to do. And I'm actually in the contrarian camp with you. I actually believe that while we may get a recession, maybe my view is more about, if we do get a recession, does it really even matter? Meaning, right, could it be a technical recession, that we get, last quarter we had a negative GDP print, but it wasn't because people weren't spending money here. It was because we had a trade deficit, right? That we had to import all of these goods that made a negative GDP print for us. But and that we're not expecting that in Q2. And Jim, I'd like to get your view on it, but if we get a technical recession, will it even matter? And then maybe Ryan, I guess you can address this in terms of, your probability of a recession. What do you think it may look like if we do get one?
Yeah, I'll jump in real fast. The consumer makes up 70% of the economy. The truth is the consumer is still in really good shape. This is you hear cash on the sidelines. What we're sharing here, consumers have almost $4 trillion, okay, in checkable deposits. So that's a lot of cushion. And believe me, the higher prices, the potentially slowing economy, all those things are mixed in there. But again, what did corporate America just say? We'll talk about earnings probably eventually here, but earnings are still strong. Corporate America is still strong. The consumer is still strong. I mean, we're not going to sugarcoat this and make everything sound perfect because I'm fully aware that they're not. But, our base case is this: the chance of a recession in the next 12 months is about 30%. Now, think about this also. This economic cycle is over 2 years old. Your average economic cycle of growth lasts about 5 years. So eventually, sure, we're going to have a recession. I mean, that's the way it happens. And it wasn't our average recession what we just had, right? I mean, I got a promotion in the middle of a pandemic. LPL grew like mad in the middle of a pandemic. Technology companies did well, but obviously other people didn't. So it wasn't your average recession where you kind of wrenched out the excesses. So maybe this cycle doesn't go 10 years like the last one, but we think there could be a couple more years at least left of economic growth. And like you said, I'll just touch on the GDP number, and then I want to turn over to Jim. The GDP number in the first quarter came in at negative 1.4%, lower than expected to be up over 1%. We've seen in the past some years we've had a negative GDP print in the first quarter, specifically 2014, and then things came back big time. We think the second quarter numbers should be good, but I love what you pointed out. Why was the number negative? You peel back the onion, as we like to say at LPL Research, 3 percentage points were taken out because of the trade deficit. Our country's opening up faster than people. We're out there buying stuff from other places. They're not buying from us as much. You can make the argument that our GDP number is actually better because we're buying and we're opening up. We're a little stronger than the rest of the world right now. That's kind of a unique way to look at it. Also, consumer spending and business investment, 2 really big parts, in housing, honestly. Those 3 big components of GDP all were stronger in the first quarter than they were in the third and fourth quarter last year. So yes, we had a negative GDP print. I mean, and by the way, GDP means your economy, guys, if economy is growing or not. But I don't think it was nearly as weak as it sounded on the surface. Jim, am I onto something there? What's your take?
Yeah, Ryan. And going back to Jimmy's point, like, even if we do have some technical sort of recession here, I just think that the chances are high that if we do have one, it's shallow and it's short, right? So as you mentioned, consumer balance sheets are really, really good. So we not only do we look at this number that shows the amount of cash that they have, but like the net worth has gone up. Yes. The debt has been paid down. And it's not just like the upper middle class or the middle class, all the way down to the very bottom. Every cohort has done very, very well since the pandemic. And so, yeah, inflation does sting. It hurts. It doesn't feel good when you're filling up the gas tank. But like, we're prepared for it. I would argue that we're much more prepared for this inflation and what we're going through now. And even if we do have a slowdown, and the fact that there's still the ratio of 2 jobs for every person looking for a job is fantastic news.
Good point. I want to get to inflation next. We had an inflation number come out today that was a little bit higher than what was expected. I think it was 8.3%. Yeah. On the headline number, but it still went down from the previous quarter. So I think investors first took that news a little bit negatively. It looked like in the futures market, and then it turned, and we've been going back and forth all day today. I still believe we're going to have a lot of volatility until we get some of the different variables that we don't have a resolution on, such as the war in Ukraine, what's going on with the lockdown in China affecting the supply situation, prolonging the supply problems that's adding to the inflation problem. But the inflation thing is, a discussion topic that I've had with some of my clients and friends, where they think that, or they're saying that this time it's different, meaning, we haven't had inflation so long. For those of you that remember, the late 70s and in the early 80s timeframe, when we've had, inflation in the double-digit numbers and money market rates, in the teens and mortgage rates in the teens, it's a, kind of a scary time frame. And the Fed chairman at that time, Chairman Volcker, had to raise interest rates dramatically. And I guess the question I've got for you, Ryan, maybe we start with here on that is, number one, do you think that we're in a similar situation? Does this time frame look like that one to you?
Yeah, well, there's some definite similarities, right? I mean, here's a few stats from you mentioned that CPI number that came out. Food prices, guys, been up 17 months in a row. Food and beverage prices up 21 months in a row. Food at your home, they keep track of that, the Fed does, up almost 11% year over year, earliest since the 1980s. And new vehicles had a big jump, up 1.1%. Oh, and airfare, people are flying around again, apparently, up almost 19% in 1 month. So a lot of those numbers were higher than expected. Now, that's the big question, though, is are we near a peak? We think we are. I mean, we think we are near a pretty significant peak in inflation. But what some of those things I just mentioned are services, right? During the pandemic, we did a lot of goods. We bought a lot of goods. Now, as the economy's opening up, we think goods have peaked. Goods inflation has peaked, but services inflation, again, like rental cars and flying around on planes, some of those things still might have a little higher prices. But the big thing is, are we in the 1970s or not? We would say no, right? One of the big differences is overall in the 1970s, productivity was really, really low. We don't think we're quite as low in productivity as we are now. And I'm fully aware we had a productivity number the other day that came in really weak. That was similar to that GDP conversation we had, though. Some of the trade numbers are taken out of that. But I want you to look at the screen for a second. So I traded options for 11 years, so I kind of have a trader's mentality, if you will. This cover came out in 2019. Is inflation dead? Are you talking about one of the greatest contrarian covers of our lifetime? If you'd have bought anything that had to do with inflation back then, we know what inflation's done. Here's what we think. I mean, there's so much bad news that's out there, so much high inflation. It's likely priced in. Some good news. Let's just try two bits of good news. Used car prices are really collapsing here, Jimmy. 3 months in a row, used car prices have come down a lot. There's something called the Manheim used car index, and they track used car prices. Used cars make up like 4% of CPI. All right, if used cars are starting to come down significantly, yeah, those other parts are still high, but we think we're near a major, major peak. The other one is shipping costs. On the right, this is shipping costs, all right, from Shanghai to Rotterdam to LA to New York. Down almost 30% from the September highs. And again, it's not perfect. There are the supply chain concerns. All these things are still mixed in there. But some of the recent supply chain data that we just saw from some data we had last week, there's more empty ships that are there. Used to take 35 days to unload ships out in LA. Now it's like 9 or 8 days or so. There are some, is it light at the end of the tunnel? Or is it a train coming at you? That's the age-old question, because we thought inflation is going to peak a couple times last few years. Then we have, then there's Omicron. Then there's a terrible war in Ukraine. And then there's China shuts down. So we keep having these things that are taking place. But overall, our chief economist, a guy named Jeffrey Roach, who just hired him from Visa a couple months ago, he thinks we can hit probably a 4 handle on inflation by the end of this year. Last comment, as quickly as inflation went up, remember this is year-over-year numbers, it can come down fairly quickly as well. So maybe we need to have maybe cross our fingers, but we do think that inflation here can start to have a pretty big peak and roll over, and that can be a domino effect to bring back a lot of confidence, which is what we need. We have a lack of confidence right now, let's be honest, and lower inflation, which could be coming sooner than later, is something we do see.
And we've had some conversations, Ryan, in our investment committee, very lively around, we have an overweight in energy. But
Yep.
we know, and commodities, but we know how quickly that can change. And so with resolution and with the war in Ukraine, we think that oil prices will probably go down. Shipping prices is something that we track. Jim tracks that on a weekly basis for the investment committee. Jim, in terms of your view on commodities, energy prices, while we have that overweight, I just want to have you reiterate for the people that are listening that we're looking at it with a very sensitive eye, that we're going to, probably change that view. While we don't ever make like big market bets or make big shifts in anything, can you kind of talk about that a little bit?
Yeah, absolutely. So we're really watching commodities and oil prices real carefully here. These things can change very, very quickly. And as Ryan mentioned, as fast as they go up, they can come down very quickly. If we get resolution with Ukraine, Russia, these things can come down very fast, we believe. And we also believe that there could be some demand destruction. Sometimes we hear that term thrown out there. This is where, people just kind of get a little bit tired and they're like, we're gonna forego some travel. We may not be there yet, because there is, as Ryan mentioned, there's some pent up demand. People that, weren't traveling, they weren't spending on services and things like that, they were locked down for so long. And so, and people's balance sheets are in good shape. So they may do that, but at a certain point in time, they may say, okay, we're gonna, reduce some of that spending. So that naturally, I think, would reduce some of the demand. What we have going on in China with lockdowns over there is going to also keep oil prices, lower than they might otherwise be. But yeah, we're looking at that. We're looking at, commodities. One thing that's important to keep in mind too is that the energy sector overweights that we have, there are not 100% correlated with what's happening in oil. Some of the energy exposure here, producers, they're actually doing very, very well from a cash flow standpoint. So even if oil prices come down, they're still doing very, very well. So those two things may not happen exactly at the same time, but commodities for sure is something that we're paying very close attention to, as well as energy.
I want to just jump in just for one quick second to put a little context around this. You mentioned energy overweights. Guys, if you look at the material sector and the energy sector, it's about 7% of the S&P 500. That's one Apple. So Apple is the size of all the material and energy groups. So again, you talk about things that are kind of small that really haven't people caught on yet. I mean, we think both those groups, there's some other factors out there, but both those groups are having a lot of earnings and some momentum here. And there could be some continued outperformance, kind of how we see on both those fronts, honestly.
That's great. I want to shift the discussion to maybe how normal this year looks, when we look at it from a historical perspective. And before we get there, I want to talk a little bit about interest rates in the Fed in conjunction to this. But, I know that there are people that are listening that have, if you're paying attention to what the Fed is doing in terms of increasing interest rates, I know that there are a lot of people that feel that the Fed has not done a great job, that they should have raised interest rates sooner and to fight inflation. And so that's a debate that we can discuss. But for those of you that are trying to understand what happens when interest rates go up, well, the Fed's trying to curb demand, right? So when interest rates go up, borrowing costs go up, trying to control the demand by having spending go down. So, in a year that we're having where the Fed is tightening, it's interesting. I don't think we have a specific slide for that, but I know that you and I, Ryan, because you had one before, you prepared a presentation when interest rates go up. Well, we do have a slide. What happens to the market? So what most people would think is when you hear the term "don't fight the Fed," you don't want to go against what they're doing. But historically speaking, when the Fed raises interest rates, stocks do well. So Ryan, if you want to hit on that right here, it's a great thing to focus on, I think, for our listeners and viewers.
Yeah, there's so many things swirling in my head here because it's such an interesting conversation. First off, is the Fed behind the eight ball? I think you could probably say yes. I mean, they probably would admit it. The Fed has two mandates, guys: price stability and employment, right? They want to keep the economy and employment good and keep prices under control. All last year until November, they said, we're concerned about employment. And then the Fed did the Fed pivot in early November and said, okay, employment's strong, economy's in good shape, consumers healthy. Now we're going to start worrying about inflation, and that's kind of what's happened. But the way we look at it is this: when the Fed starts hiking rates, it's like taking off the training wheels, okay? Usually when the Fed starts hiking rates, stocks can go up for a long time, potentially years. And what we're sharing here on the screen, at least, is when the Fed does its first rate hike, which they did about 7 weeks ago. What happens next? Well, you can see the numbers are the numbers. There's a lot of green there 6 and 12 months later. Are all the returns astronomical? No, they're not. But more often than not, they're positive. Now, I'm aware stocks have been weak since the Fed cut 7 weeks ago. Some other factors we think are playing in there, but just on the surface, when the Fed starts hiking, that's usually not a bad thing. One final comment: in 2004, 5, and 6, the Fed hiked rates 17 times. That's a lot. Stocks were up all 3 of those years, not by a lot, but they were positive all those years. So again, it's been a while since we've seen something like this. I compare right now with kind of 1994. 94, the interest rates or Fed fund rate went from 3% to 6% really fast. Bonds had a terrible year in 94. Stock market was kind of flat, didn't really do all that much. We had the Orange County crisis, Orange County bankruptcy. We had a Mexican peso crisis, had some real big blow-ups, if you will, when the Fed hiked quickly. You know what happened in 94, though? The economy did not go into recession. We had a mid-cycle slowdown. We think this year is probably more like a mid-cycle slowdown, and then expansionary into the mid to late 90s. And that, you know, Mark Twain said history doesn't repeat itself, but it often rhymes. We think, again, it's more mid-cycle slowdown, frustrating for investors, yes, but partially that's kind of what has to happen when you have the massive gains we've had the past 2 years. Got to work out those excesses, and then you can potentially go higher. So the bottom line, when the Fed starts hiking, it's not always a bad thing, Jimmy.
Can you put up that slide on midterm election years?
Yeah,
I think it's a fascinating slide.
This one or let's see here. This one right here. This one.
Yeah.
Here we go.
I mean, it's fascinating to me. If you look at this chart, you know, the average decline in a midterm election year is negative 17.1%. I think it's since 1950. So I've been quoting this report, this research report that you guys created for the last few months. And then 1 year later, as you can see, the average return on the S&P 500 is plus 32.3%. I don't know about you guys, but I sort of feel as if where my intuition kicks in with my 7 years of experience, you know, investing money professionally for clients, I'm starting to hear some conversations with clients that sound similar. I wouldn't say panic, but I know that if we're not having conversations, I know that a lot of people out there are worried and they're concerned because, again, this inflation thing is something that we just haven't talked about for so long. It's been nearly 3 decades, you know, not having to discuss this inflation thing. And so it's fascinating to me that during the midterm election years, is there any phenomena behind this, you think, Ryan, on why this happens?
Yes. I mean, so we do think so, right? Midterm elections, usually the new president comes in, everybody's pretty happy, right? Stocks do okay usually. And then by the time you get to that second year, you start hitting some bumps, some bruises, you know, and then just the uncertainty over the election. It's an old cliche, but it's true. Markets hate uncertainty. Well, there's usually uncertainty as you get closer to those midterm elections. What exactly is going to happen? Who's going to be in power in Washington? And you can have some of that weakness. Then once you get through it, you're higher. But here's the thing. We knew coming into this year, right? We talked about this a lot at LPL Research, and Jimmy, I know you did also, that listen, be aware midterm years can be rough. And remember the movie Lawrence of Arabia, right? There's a candle and this big guy takes his finger and pinches out the candle. The guy next to him looks at it and goes, that's pretty neat. He goes to a candle and tries to pinch out the candle. He screams in pain. He goes, how in the world did you do that? The first guy goes, you just got to know it's going to hurt. That, unfortunately, everybody, is investing. We knew the midterm years usually hurt. This one's hurting more than we expected, I'll be honest, but you kind of knew coming in that that's the way it works out. And again, the key concept, no one knows when a low is going to be. I mean, let's be honest, no one knows when it's going to be, but a year off those lows, you're up 32%. One final comment here. If you look at all those dates there, the date of the low, the average is August 14th. The median low in a midterm year is September. So when we had those March lows and the bounce, one of the worries we had, we're thinking, could a midterm year really bottom in March? Of course it could, but usually you don't bottom until later in the year. That's kind of our premise. And maybe we can get a surprise at this point, a bounce. If any bounce will probably surprise people, but it's likely with the sentiment as low as it is, get a surprise summer bounce, maybe another move lower into the early fall standard midterm year stuff. And then when the election gets out of the way, and then we can kind of hopefully get, you know, maybe one of those 30% gains over 12 months, but a lot of good information there. But bottom line, midterm years hurt. And we just have to know that. And that's what's happening.
So a lot of times clients will ask, well, if you know this going into it, then why wouldn't you guys sell, you know, and get out of the market during those years and then try to buy the dip, I guess. And I think you've already, said the answer, which is we don't know when the low is going to happen. And it doesn't always happen all the time, the exact same way. Every time it's a little bit different. But trying to time the market has not been a strategy that's been a prudent investment strategy for success for long-term investors. And getting out of the market, you have to ask the question, when are you going to get back in? And there's a lot of statistics that we always look at as advisors. You know, if you miss out on the biggest gain days in a bull market, then your return goes down dramatically. Well, guess when the biggest gain days often are? It's usually after the biggest loss days.
As soon as you sell, usually.
Yeah, and it happens fast. So that's why most financial advisors would probably tell you that trying to time the market's not a great prudent investment strategy. But I will say this, I mean, so much of our job as advisors, the advisors that you work with, we're professionally trained with experience, and our job is to try to help our clients, make better decisions by managing their expectations. Because when investors, hit the panic button, it's not necessarily a logical decision, it's an emotional decision.
Right.
So helping our clients manage their behaviors by setting expectations and communicating as often as we can, like we're doing right now. I know that even if your advisor may have said, hey, look, this is what you can expect in a portfolio like this, when the market goes down, here's how often historically it happens. Sometimes we don't remember all those things. And it's always good for us to reiterate, what you should expect, and that downturns are not, if we're going to get them, it's just when they might happen. Right.
Yeah. One quick comment on that. Energy stocks are up like 50% the last year. There are some groups that are up, and I know we're saying these numbers are down. It's because tech, which you guys are underweight, is pulling the market down a lot. So yes, overall, you're probably down if you have a stock portfolio, unless you're just in energy, but we wouldn't say put all your eggs in one basket. But we probably thought there'd be some weakness. But again, consumer staples done well, utilities done well, healthcare is starting to look a lot better for the first time in a while. So just because the stock market's down, remember after the bubble in 2000, 2001, 2002, value stocks were up, all right, those 3 years. It was tech and growth that got killed, and the market was down. So again, it's kind of how you construct the portfolios, and the way you guys are constructed them. What we talked about earlier is, people are still probably down, but boy, you're a lot better off than what a lot of other people are.
I personally checked in with our trading desk and asked the head of our trading desk if clients were actually selling, getting out of stocks and going to cash, or money was going in. And the answer that we got from the head of our trading desk was, no, there were very few examples of clients getting out, and there's more examples of people adding money. So I think, a pat on the back for the advisors that are within our group here, and also the clients, for you as investors that understand that. Another thing that I like to try to point out is, whether you like Warren Buffett or not, it's hard to argue that he's been definitely one of the most successful investors of all time. And, he didn't invest a lot of money after the pandemic started, which people can argue was good or bad, but he did put, it looks like $51 billion to work in the stocks that he wanted to buy and add to for Berkshire Hathaway in the month of March, and with some buyback. So he invested a big chunk of the cash that he's been holding on to for a long time. And, the shareholder meeting was recently. And, obviously he's finding some value in the market that he hasn't seen in a long time. I have also been asked some questions, from investors and advisors this morning on our advisor call about some of the growth stocks, some of the high flying growth names. I mean, this is my personal opinion. I thought that it was kind of crazy that investors were putting so much money into some of the growth names that were some of the retail favorites, and pushing the valuations to astronomical levels. And I've been very vocal in interviews myself saying, hey, that's not something that we believe is a prudent thing to do, just chasing an investment just because it's going up. And so I think that, because a lot of those stocks are down 50, 60, 70% or more, a lot of household names that became famous during the pandemic. So I just don't think that they were, should have ever gone up that much. And so, sure, was there some speculation going on in the marketplace? Absolutely. We don't have time to talk about crypto on this call, but maybe we'll save it for the next one. But there was also, I think, speculation in those assets too. So I don't know if you want to talk about the idea of selling May or not, or maybe switching to earnings to kind of round up the rest of this call.
Yeah, just real quickly on this. This is the presidential cycle broken up in 4 years. So you talked about like, okay, well, if you knew it was going to be bearish, why didn't you predict it, or why'd you not listen? These next couple of quarters of week, guys, look at how strong some of those other ones are. So again, likely much better times are coming ahead if you just look at purely on history. But yeah, let's do let's see here. We can do sell in May real quickly. The worst 6 months of the year are right now, May through Halloween. And it's like, oh my God, we just had a terrible start to the year. Now you're telling me this, and you can see the returns there. But here, let's have a little good news. That is the worst 6 months. You can see there at the bottom. Here's a little good news for you though. The past 10 years, these worst 6 months have been higher 9 of the last 10 times. Right? Once everybody starts talking about something, maybe the market's figured it out. But again, this kind of fits in with our idea at LPL Research that maybe we're going to have a surprise. At this point, we'll call it a surprise summer rally here. And these 6 months likely will be higher. Jim, what do you think? Is there going to be a sell in May, or what's your take?
I don't think so, Ryan. I think, you mentioned this a while ago, the market sometimes needs to take a break. There needs to be some resting. Sometimes it needs to go sideways. I think that's healthy. If we do have a straight up market, that actually worries me quite a bit. If we have a straight up market, then there's no support. If the market, pulls back, I think we've had some consolidation here, and hopefully we do get a bottoming process in. So I don't think there's a lot of downside between now and October. Maybe we trade sideways, but I'm optimistic. Going back to the whole midterm, talking about that, we have a lot of uncertainty just with the midterm. I think it's been a perfect storm when you add in Russia, Ukraine, and you add in the Fed. There's just been this big wall of worry that the market is dealing with, and when you remove some of those things, all of a sudden, I think it looks a lot more positive. So I don't think that the sell in May trade works out the way it has in some of the past years where you want to do that. I think now, probably more than ever, you want to stay invested.
Yeah, I can't remember. It's been a while for me anyway, in terms of how much pessimism there is right now. Over this last week or so, watching the news and watching some investors that are famous investors talking about the economy and the markets and all that. And historically, for me anyway, my personal experience is being a contrarian to what everybody else is saying feels really good and usually always works out. So in my 27 years, I started in the business in 1995, huge run up with the internet bubble. Then we have a 50%, market decline from 2000 to 2002, recover a bit, and then have another huge decline with the financial crisis, starting in 2008 and bottoming out in 2009, another 50% move down, then through this pandemic, a very quick 30+% decline in S&P 500 in March of 2020. So a lot of volatility during that time. And there's not been one time, me personally, where I wish I could have maybe talked to my clients and did a better job of communicating to add more cash during those declines. And you and I, Ryan, spoke a little bit earlier about your personal view about where we're at. I don't think you think this is going to turn into one of those big bear markets that averages 35% or more, but maybe more of a kind of where we're at right now, 15 to 20%-ish. And so anyway, as far as the slides, the title is great. People are very scared. I sense that if advisors have not been talking to their clients that much, and if the clients have not been reaching out, but I still feel like it's not because they're not scared. I feel like they have a lot of concern because this inflation thing does sound a little bit different because we haven't talked about it in so long. And so with that, maybe you can talk a little about this and the people's state of mind.
Yeah, just, the truth is, when everyone's thinking, what's Patton said, if everybody's thinking alike, somebody isn't thinking. And right now, everybody's pretty bearish, and rightfully so. It's been a rough start. I really love Barron's, right? Barron's magazine comes out every weekend, read it over the weekend. It was like the most bearish I've ever seen Barron's. Okay. I mean, so everyone's talking about all these bad things, and it's how much is priced in, right? It's all about what the market is looking forward. And it's not about like, good or bad. It's about like better or worse. We just started getting some slightly better news with all the stuff. And what I'm sharing on the screen here, global growth optimism near an all-time low, percentage of cash on the sidelines is near highs, lowest number of bulls we've seen in years in sentiment surveys. We can go through it all, but it's not a surprise, right? Sentiment's awfully low. We've seen that before, March 2009. We've seen that in March 2020. There's been other times when sentiment's low and things are terrible. The headlines are horrible. Everything going on is just really, really bad. But that's kind of what happens because all the sellers have already sold. And the only thing left is really for buyers. Now, could we have a little more weakness here? Sure, we probably could. But Jimmy, to answer your question, if you have a recession, bear markets go down like 35%. If you don't have a recession, you can't have a bear market without a recession. It's like low 20 percentile. We had a 34% bear market in 87 without a recession. Excuse that. We've had some other times, right? In 2011, stocks are down 19%. 2018, stocks are down 19%. 1998, stocks are down right about 20%, give or take, without recessions. We're not too far from there. We don't see a recession. So to us, might feel uncomfortable, trust me, after what's happened, but this is kind of one of those opportunities. They say the stock market's the only place things go on sale, but everybody runs out of the store screaming. People are running out of the store screaming. Things are on sale. You know what to do. It's probably an opportunity.
You want to touch on earnings before we kind of wrap up with the summary?
See if I can get there.
Yeah.
Here we go. And maybe. Get a drink of water. Sorry, the weather's crazy down here. I almost made it without coughing. Give me 1 second here.
One of the things that we follow, obviously, as an investment firm, is earnings, how profitable companies are, and we have discussions about this every week on our investment committee, and we're tracking it. And earnings are still really solid. So Ryan, what's your view on that?
Yeah, thanks for buying me a second there. Yeah, so I think the weather's gone crazy, and I know Carolina's got a little cough here. But yeah, I mean, here it is. This is the S&P 500 earnings. That's the blue one going from the bottom left to the upper right. Earnings are really strong. Earnings this year might grow 10%. They grew 50% last year. What about the rest of the world? You can see there emerging markets, because what's going on with China and Russia, specifically in China, big time drop, right? Europe kind of stalled. I mean, Europe might be in a recession. I heard someone pointing out in 2009, U.S. obviously was in a lot of trouble. China wasn't in as much trouble. China kind of helped pull us in a way out of the global recession. Right now, it's kind of the opposite. China's in a lot of trouble. Europe's in a lot of trouble. We're kind of going to pull, we think, the rest of the world out of trouble here. But if you think earnings drive long-term stock gains, which we do, you see earnings estimates continue to increase in the U.S. That's a positive. Why we like the U.S. more than anywhere else in the world. Now, maybe we'll leave with this. What's a price PE multiple, right? The price relative to earnings, how much you're willing to pay for something. Well, stocks this year are down. We get it. I mean, they're down a decent amount, right? But PE multiples are higher. Earnings are higher. So that means bottom line, stocks are a lot cheaper now than they were at the start of the year. One of our worries coming into this year was stocks were pricey. It is what it is. That was a potential worry. Now stocks aren't so pricey. They've come back down. The pitches come in, the ball's in the middle of the plate. Are you willing to swing? We think there's some really nice opportunities now, as earnings have been strong, to justify, which is still likely a pretty solid economy and likely a buying opportunity for longer term investors.
Thanks, Ryan.
Mm-hmm.
I hope the presentation reiterated the fact that obviously we didn't want to send a message that we think that the economy is going to go into the toilet and the world's going to end, right? So yeah. I knew that you didn't know that we were going to talk about that, but what we hope that we showed you are some facts and some history to kind of talk about, does this market look a lot different than historical markets? As far as declines go, corrections and bear markets are completely normal. So on the way to historical strong positive returns for the stock market, we have to have some of these down years. And I hope we answer the question on timing of why we don't recommend trying to time and try to go in and out of the market. And so a lot of the investment portfolios that are out there are being used to fund a goal, that's a financial planning goal. So I think those are the discussions that we as advisors need to turn our attention to with our clients, and make sure that our clients feel comfortable and confident that their financial goals are still on track, and that this volatility is not something that wasn't necessarily unexpected. We don't like it. None of us like it. We have a lot of empathy for the pain that people feel and what it causes when it causes for emotional stress. We understand that, but communication is, I think, key during times like this. So I would encourage those of you that are listening to contact your advisors, start those conversations. I know that our advisors are trying to do the best job we can with trying to be proactive with communication by doing presentations like this, so we can reach a lot of people with a message. Hopefully that makes sense, but we're always available for the one-on-one calls. And so with that, I think we're going to wrap up. We're just about 50 minutes into the presentation at 12:50. I want to thank Jim Chief Investment Officer of the Wealth Consulting Group. And Ryan, you did a fantastic job. You're also a heck of an entertainer. Can't wait to do this again with you. Really appreciate you and the support that LPL Financial gives to the Wealth Consulting Group and the partnership that we have as well. And again, I want to thank the clients on this call that have entrusted, your wealth and money to us, and hope that you know that we care deeply about your goals, and that we're going to do everything that we can to help you be successful with all the financial objectives that you have. So thank you very much for your attendance today, and hopefully we get to see each other and talk soon. Bye-bye.
Thank you.
Thank you.